Thinking about investing in mutual funds? Great choice. They're a popular way to start building wealth because you get diversification and professional management right from the start. But don't just pick the first fund you see. It's important to know what you're getting into before you invest. Many people rush in because of FOMO, buy high, panic when the market dips, and sell low. That's how you lose money. The key is to be prepared and make smart, informed decisions from the start. In this video, I'll share the 5 most important things you need to know before investing in mutual funds. Let's get started. Before you look at any fund, lock down your investment goal. Why are you investing? Is it for a house in 5 years, retirement in 30, or a big vacation soon? The timeline matters. If you need the money soon, be conservative. If you have decades, you can take more risk for higher returns. Write your goal down. A clear goal is your North Star, guiding your decisions and keeping you focused. Invest with purpose, not just for the thrill. Okay, once you know your goal, the next step is to figure out your risk tolerance. This is basically a gut check on how you'd feel if you saw your investment account drop by 10%, 20%, or even 30% in a short period of time. Would you panic and sell everything, locking in your losses? Or would you see it as a buying opportunity and stay the course, knowing that markets eventually recover? Be honest with yourself here. There's no right or wrong answer, but being dishonest will only hurt you in the long run. Everybody wants high returns, but not everybody has the stomach for the volatility that comes with it. Your risk tolerance is a mix of a few things: your personality, your financial situation, and as we just discussed, your investment timeline. If you're young, have a stable job, and are investing for retirement, you can generally afford to take on more risk. You have decades to make up for any potential losses. But if you're closer to retirement, or if losing a chunk of your investment would seriously impact your quality of life, you should lean towards lower risk options. It's all about finding a balance that lets you sleep at night. Mutual funds come in all flavors of risk, from very conservative bond funds to aggressive growth stock funds that invest in emerging markets or small companies. Understanding your personal comfort level with risk will help you narrow down the universe of thousands of mutual funds to a much more manageable list. If you're risk-averse, you'll be looking at bond funds or balanced funds. If you're a risk-taker, you might look at small-cap or international stock funds. Matching the fund's risk profile to your own is absolutely crucial for sticking with your plan. When researching funds, most people start with performance history, and that makes sense. You want to see how a fund has done in the past, and it's a good starting point. But remember, past performance is not an indicator of future results. Instead, compare the fund's returns to its benchmark, like the S&P 500. See how it performed in good and bad years. Did it beat or lag behind the index? This gives you real context and helps you judge if the fund manager is earning their fees. Fees might seem small, but they're the silent killer of your investment returns. Even a 1% expense ratio can cost you thousands over time. Always check the expense ratio when choosing a fund. On $10,000, a 1% fee is $100 a year. A low-cost index fund might charge just $5. Over decades, that difference adds up, big time. So always look for the lowest fees. Your future self will thank you. Finally, let's talk about the person, or team of people, actually making the investment decisions, the fund manager. When you invest in an actively managed mutual fund, you're essentially hiring this person to manage your money for you. You're paying them, through that expense ratio we just talked about, to pick stocks or bonds that they believe will outperform the market. So, it makes sense to do a little bit of research on who you're hiring, right? You wouldn't hire a contractor to build your house without checking their references. You'll want to look into the fund manager's experience. How long have they been managing this specific fund? Have they managed other funds before? What is their track record like, not just in good times, but during market downturns? A manager who has successfully navigated multiple market cycles is often a good sign. You can usually find this information in the fund's prospectus or on financial websites like Morningstar. Look for consistency in their investment philosophy. Do they stick to their stated strategy, or do they chase hot trends? Now, this is more relevant for actively managed funds, where the goal is to beat a benchmark. If you're opting for a passively managed index fund, the manager's role is much simpler. Just replicate the index. In that case, the manager's track record is less important than the fund's expense ratio and its tracking error, which is how well it mirrors the index. But for an active fund, the manager is the captain of the ship. A great manager can be worth the higher fee, but a bad one can lead to years of underperformance. So do your due diligence and find out who's behind the wheel. And there you have it, the 5 essential things you need to think about before you dive into the world of mutual funds. It might seem like a lot to remember, but it really boils down to doing a little bit of planning up front to save yourself from potential headaches and lost money down the road. It's about being an intentional investor, not a reactive one. By defining your goals, understanding your personal risk tolerance, and then properly vetting the funds based on their performance, fees, and management, you're putting yourself in the driver's seat of your financial future. So to quickly recap, first, know your goal and your timeline. Second, be honest about your risk tolerance. Third, look at past performance for context, but don't treat it as a crystal ball. Fourth, and this is a big one, scrutinize the fees, especially the expense ratio. And fifth, know who is managing your money. Keep these 5 things in mind, and you'll be so much better prepared to make smart mutual fund investments that align with what you actually want to achieve. This framework will help you cut through the noise and focus on what truly matters. Investing doesn't have to be overly complicated, but it does require a bit of effort. By watching this video, you've already taken a huge step in the right direction. The goal isn't to become a stock-picking genius overnight. It's to build a solid, sustainable plan that you can stick with for the long haul. That's how real wealth is built. Thank you so much for watching. I really appreciate your time. Don't forget to hit the like button if you got some value. Subscribe for more content just like this, and let me know in the comments which tip you found most helpful.